Hi, Paul Gerard from Price Accounting Services, back again for another video in our series on investments. In this video, we're going to look at deductible investment costs. So, when investments produce income from interest, dividends or trust income, etc., the costs may be tax deductible. However, where investments do not produce income and expected only to produce capital gains, those costs may not be deductible, but will be considered in the CGT calculations. So, an investor that is doing both must be very careful to apportion. You can't just say, well, I incurred all the software based on my income producing and not the CGT. You may have to apportion it, okay? Same as if you use borrowed money, etc. So, examples of deductions for investors who produce income. So it could be things like share site fees for your subscriptions there, stock doctor, etc. Limited home office hourly deductions might even be available. Note that the home office may need to be set aside for a dedicated purpose, and then you might need to keep records of the number of hours, etc. And there could be a percentage of internet and so forth. Brokerage is not in itself deductible, as including the cost of the investments and the net proceeds on disposable for the CGT events. So ignore the brokerage if you're a investor holding for income, etc. But if you're a share trader, we have a separate video on the issues there. Now, interest poses some issues, and we want to consider this matter carefully because it could affect deductions. So many people are using home equity to loans, etc., to borrow to buy investments. And where you're only acquiring income producing investments, that's all pretty straightforward. But let's start with looking at some of the key issues. The first of ones is where the borrowed funds are directly used to acquire income producing investments. So that's going to be tax deductible, no problem. But buying shares or investments that don't produce income, i.e. Bitcoin, you've got a problem, okay? Because you can't deduct the cost for the interest on that borrowing, but it could be an element of the cost base for your Bitcoin you need to include as an adjustment when it's sold. So you might have deductions throughout the full 12-month period and sell in the 14th month, so you're going to have to wait over a full year before you get the merits, and then you may even lose half of its value to CGT discounting. Okay. Alright, an issue can occur too when borrowings are repaid when shares are sold. Now, we've got a video on this which suggests some tips to how to manage borrowings when you use the borrowed money to invest, okay? That video is very specific to the issue, so look for it in one of the following videos, okay? Now, the third key issue is who is the borrower and who is the investor? And this can give rise to a trap where you lose all deductibility. So the general rule is this: the investor must be one of the borrowers that borrows from the bank. i.e., if, let's say, the investor is the wife and the husband and wife are joint borrowing, no problem. But in the situation where, for example, the husband has borrowed the money, the loan is in his name, and the wife is doing the investing, then you have a concern because the wife has not legally incurred any interest whatsoever. The ATO will quite willingly disallow the deductions and you'll have no grounds for appeal or objection, okay? So the simple solution is an on-lending loan agreement from the husband to the wife, which we can assist and facilitate with our solicitors. Such a loan agreement then may mean that the husband is paid interest by the wife, claims a deduction for the interest he pays to the bank, so his net effect is zero. Then the wife will claim a deduction for the interest she pays her husband. So the net effect of the borrowings benefit the wife. So the husband can't claim the deduction and not be the investor either. So clear up that misconception right now. The other fourth concern with borrowing is, can the parties even legally contract? Now we see this happen with trusts. So the husband borrows, and the husband is the human trustee for the family investment trust. Can a trustee or can a person borrow from themselves? No. So this is where a company trustee may have been the correct choice to avoid that issue. Alternatively, if the husband and wife have borrowed, it might be from the bank, it might be that the wife on-lends to the husband in his capacity as the trustee using a loan agreement. So it can be solved. It does involve slight extra cost, but it protects and preserves the deductions. Okay. When it comes to investment deductions, I have to caution about courses and education. Okay. Care should be taken that many firms seek to educate investors to invest in other products like CFDs, learning to trade and things like that. Generally speaking, this might not be deductible. The reason it might not be deductible, it's preliminary to the activity, and it is also an education cost incurred to produce a new form of income. It's new learning to acquire a new skill to produce new streams of income. So that will generally not be deductible. However, let's say you had a track record of producing income from buying and selling and holding simple ETFs and shares, and you wanted to expand into other forms of investment, then gaining further knowledge may well be deductible. Okay. It's necessary to be very cautious, however, when it comes to many of these very, very high fee paying services. The ATO will always consider a request for a private ruling. We will often recommend that you obtain one for certain very high value deductions where the claim might be a bit dubious. For example, if you've never traded in Bitcoin and you argue that your trading in Bitcoin is going to involve Bitcoin lending arrangements, etc., I would argue, as somebody who's never invested in Bitcoin on that basis, it's easily argued that there's no nexus between the course and the existing investment and the proposed future investment without the certainty of a tax ruling. Okay, so a bit of warning there for that. The other one I commonly see is investors who get lured into schemes, arrangements, spruikers, who suggest they've got some miracle magic black box that'll pick what to buy and it's also perfect and positive. Warning, 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 this is generally a scam. There is no such mythical magic black box, and if there was, every trader in the world would use it. Even the likes of specialist firms who do high frequency trading don't rely on such miracle methods. So a word of warning there. We have seen many people seek deductions for these, and they are commonly disallowed on review because $10,000 for a course when you've never traded in anything, it's not going to fly. Okay, so if you need advice or guidance in the area, we do welcome it. We will look at the nature of the cost, we'll look at the nature of what you've been doing and give you some general guidance and advice, but we may ultimately recommend for your own protection a private ruling, and we can guide you on that, so it doesn't need to be that expensive, where you're able to satisfactorily explain yourself to the ATO and produce the necessary information for them. Then it might be completely free, and we can always guide and assist you doing that. Okay, so I hope that's helped guide you on deductible investment costs, and if you have any questions in those regards, we do welcome those from clients, and Until then, we hope you enjoy other videos in this series, this channel on investments. Okay, thank you. Bye.